Welcome back. Imagine the vast, intricate plumbing system that keeps our global financial markets flowing. What happens if a critical pipe suddenly narrows? Or, even risks clogging? That's the unsettling question analysts are asking about the U.S. dollar system right now, with warnings pointing to a potential liquidity crunch, possibly as early as mid-September. Today, we're taking a deep dive into these, obscure but vital mechanisms to understand exactly what's going on and what it could mean for the broader economy and for you. But before we plunge into the financial deep end, so a quick note. For anyone looking to truly understand the foundational forces that have shaped global history, we think Hui Wang's A History of China series, available on Amazon, is just an essential resource.
Oh, it truly is a monumental work, really. This series offers an incredibly deep and compelling look at China's past. And that's absolutely crucial for anyone wanting to grasp its present and future trajectory. It's not just facts. It really brings the narrative to life.
Yeah, and what's brilliant about it is, while it's meticulously researched, it's also incredibly accessible. So whether you're a seasoned historian or just someone curious, you'll find it captivating. The latest volume, for instance, delves into the Jin Dynasty with remarkable detail and insight.
Absolutely. And it's available in both ebook and paperback formats, which makes it really easy to pick up and dive into. For anyone aiming to truly broaden their understanding of global history, beyond the headlines, Hui Wang's series is genuinely a must-read.
Speaking of foundational forces, let's shift our focus to something hitting a bit closer to home. The U.S. financial markets. We're seeing some pretty stark warnings from major banks, like Barclays, about potential liquidity stress in the dollar system, possibly around mid-September. So what exactly is causing this concern, and where do we even begin to unpack something as complex as dollar liquidity stress?
That's a great question. And to understand it, we really have to start with a facility many people might not have even heard of, the Federal Reserve's Overnight Repurchase Agreement, or on RRP for short.
On RRP.
Think of it like this. For major financial institutions, especially money market funds, the on-RRP has been acting as a super safe interest-bearing parking spot for their excess cash. It offers a risk-free rate, currently, 4.25%, making it an attractive alternative to other short-term investments.
And how big did this parking spot get, at its peak? What kind of scale we're talking about here?
At its peak, it held an astonishing $2.2 trillion.
Wow. $2.2 trillion.
Yeah. Imagine that kind of money just sitting there earning interest overnight. It acted as a crucial safety valve in the system.
But something dramatic has happened at that parking spot, right?
Yeah.
It's not nearly as full as it once was.
Not at all. The usage of the on-RRP has just collapsed, and it's happened incredibly fast. On August 15th, for example, balances plummeted to just $33.8 billion.
$33 billion. From $2.2 trillion.
Exactly. That's the lowest level we've seen since 2021. And it's not just the amount of cash. The number of counterparties, the financial firms actually using the facility, shrank from 62 in July to a mere 14.
That's a really sharp drop. So what's driving this rapid outflow? Where's all that cash going?
Well, there are a couple of key forces at play here. First, the Federal Reserve has been actively reducing its balance sheet, quantitative tightening. That essentially means the Fed is pulling liquidity out of the system overall.
Right, QT.
But more directly impacting the on-RRP, there's been a massive surge in the issuance of short-term U.S. Treasury bills.
Okay, so if the on-RRP was like that giant risk-free savings account for money market funds,
yeah,
how does that connect with Treasury issuance?
Imagine it this way. The U.S. Treasury, needing to fund government operations, has been issuing a flood of new, very attractive short-term bonds, T-bills, essentially IOUs. These new Treasury bills often offer slightly higher yields than the on-RRP.
Ah, okay, so it's a better return.
Exactly. So to buy these attractive new bonds, those money market funds are pulling their cash out of that on-RRP savings account and putting it directly into Treasuries. It's like a massive redirect of cash from one safe haven, the on-RRP, to another, the Treasury bills. But it effectively pulls that money out of the Fed's direct facility and pushes it into the broader market. In fact, one bank even predicted the on-RRP balance could hit zero by the end of August.
Wow. From trillions to potentially zero. That's quite something. So if that giant on-RRP safety valve is rapidly draining, what are the other critical pressure points we need to watch in the system? Where's that cash flowing now? And what accounts are becoming central to this liquidity discussion?
That's precisely the key shift. With the on-RRP fading from the picture, the focus immediately turns to two other crucial accounts: bank reserves and the Treasury General Account, or TGA.
Bank reserves and the TGA. Okay.
These are kind of the twin pillars now holding the bulk of the system's immediate liquidity.
Could you walk us through what bank reserves and the Treasury General Account are for our listeners, and why their levels are now so central to this discussion?
Certainly. So bank reserves are essentially commercial banks' deposits held at the Federal Reserve. Think of them like the bank's own checking accounts at the Fed. They earn interest currently around 4.4%.
Yeah.
These reserves are absolutely vital. They're the bedrock for interbank lending and the financial system's overall liquidity. Right now, they stand at about $3.33 trillion.
$3.3 trillion, got it.
Then you have the Treasury General Account, the TGA. This is effectively the U.S. Treasury's main checking account at the Fed. It holds cash collected from taxes, bond sales, other government income. Its balance can fluctuate wildly, depending on government spending and revenue. Right now, it's around $504 billion.
And that's up significantly, right, since the debt ceiling deal?
Exactly. It was down around $260 billion before the deal. The Treasury's been aggressively rebuilding its cash buffer since then.
Okay, so we have the on-RRP draining. We're watching bank reserves, currently at $3.33 trillion, and the TGA, which is building back up to around $500 billion. What's the central worry here for mid-September? How do all these pieces fit together to create this potential liquidity squeeze?
This is where it gets critical for you, the listener. The central worry is this. With the on-RRP already essentially drained, any further replenishment of the TGA as the Treasury keeps building its cash buffer, coupled with major September tax payments and bond settlements, could cause those crucial bank reserves to dip below $3 trillion.
$3 trillion, that's the number.
That's the level many analysts see as a potential flashpoint, a critical threshold where, stress could really start to emerge in the system.
And is there a specific date circled on analysts' calendars? What makes September 15th in particular such a potential flashpoint?
September 15th is indeed the date everyone is watching closely. That's when quarterly corporate tax payments are due. And that's a huge drain on liquidity. Barclays estimates those taxes alone could pull approximately $100 billion out of bank reserves on that single day.
Wow, $100 billion just from taxes.
But it doesn't stop there. Bond settlements throughout the month could pull nearly another $200 billion more by month's end. Put it all together, and you could potentially see reserves push below $2.9 trillion. It's like a financial perfect storm brewing over just a few weeks.
That sounds like a significant amount of cash being pulled out in a very short time. This immediately brings to mind what happened back in September 2019, doesn't it? Can you remind us what occurred then and why that event is so relevant now?
It absolutely echoes the repo market turmoil of September 2019.
Yeah.
For listeners, the repo market is basically the plumbing system of the financial world. It's where banks lend and borrow cash from each other overnight, often using safe government bonds as collateral. It's how they make sure they have enough immediate cash on hand to meet daily obligations, keep everything flowing smoothly.
Right, the essential short-term lending market.
Exactly. And in 2019, similar cash drains, though, for slightly different reasons back then, sparked a really dramatic liquidity crunch. Banks simply didn't have enough ready cash, enough reserves, to lend to each other in that repo market. And this caused overnight borrowing rates, which are normally super stable, to just spike. They went from a calm 2.2% to over 10%.
10%? That's huge for overnight rates.
It was a real shock to the system, a sign that the plumbing was seriously clogged.
That sounds like a classic financial traffic jam. Everyone needing cash at once, and suddenly the roads are gridlocked. And if I remember correctly, the Fed had to step in big time back then, right? Like a traffic cop.
Precisely. The Federal Reserve had to intervene and inject a massive $500 billion into the system just to restore order and get those borrowing rates back under control. So the concern we're discussing today isn't just theoretical. We've quite literally seen this movie before, and it wasn't exactly a feel-good hit for financial stability.
Right. So given that history, why are some experts, like the ones at Barclays, suggesting that a repeat of 2019 is maybe unlikely this time around? What makes them more optimistic?
It's a crucial counterargument, and Barclays provides some compelling reasons for their optimism. First, they point out that markets have already absorbed a really heavy wave of Treasury issuance this summer without significant disruption.
That's true.
That suggests a degree of resilience has already been built into the system, perhaps more than in 2019.
Okay, so the market's handled a lot already. Does that factor in the expected slowdown in Treasury issuance later in September, too?
It does. Barclays notes that while issuance has been heavy, it's actually expected to slow down a bit later in September. In fact, some Treasury bills maturing that month might even reduce the net supply of Treasuries hitting the market. That could effectively create less demand for cash, providing a bit of breathing room.
Okay, so less new supply coming online.
Right. But perhaps the biggest reason for their optimism, and this is really significant, is that the Fed has much stronger safeguards in place now than it did back in 2019. Its standing repo facility, the SRF for instance, can provide up to $500 billion in liquidity on demand.
$500 billion, just readily available.
Exactly. It acts as a reliable backstop. It's a clear signal to banks that liquidity is available if they need it, which wasn't as clearly established back then. And the Fed could also restart what are called term repo operations, lending cash against collateral like Treasuries for longer periods, providing even more flexibility.
So Barclays is predicting more of a, what do they call it, a heart murmur, rather than a heart attack for the financial system this time. That's a pretty nuanced distinction. So I guess we shouldn't be stocking up on emergency financial rations just yet, right?
Yeah.
How are they quantifying that heart murmur? What are the actual projections?
Yeah. Maybe hold off on the rations for now. That's a good way to put their view. Barclays projects that while bank reserves as a share of total bank assets could dip below 12%, they should, importantly, stay above their own perceived danger threshold of 11%.
Okay, close, but above the line.
Right. And as for short-term rates like SOFR, the Secured Overnight Financing Rate, which is that key benchmark for bank borrowing costs, they expect it to rise only modestly. They're talking less than 7 basis points, so less than 0.07%, above the effective federal funds rate. That's what they mean by a heart murmur. A small, perhaps noticeable flutter, but not an alarming spike like in 2019.
That sounds somewhat reassuring on the surface. But even with Barclays' optimism, are there lingering concerns? Or crucial nuances that still keep other analysts, maybe even some Fed officials, a bit worried? Where's the disagreement?
Absolutely. And this is where the story gets, well, really interesting and complex. First, there's just not universal agreement on what constitutes that safe line for reserves. Some Fed officials, like Governor Waller, have argued reserves could potentially fall to maybe $2.7 trillion without causing significant trouble. But then you have others who warn that anything below $3 trillion is already pushing it, entering risky territory.
So even the experts disagree on the exact threshold.
Exactly. And for you, the listener, the key insight here isn't just about one specific number, but the uncertainty around that number. It highlights how complex these assessments are and why market participants will be keenly watching for any signs of stress, regardless of where someone thinks the official red line is. It shows the difficulty in pinpointing the cliff edge.
That's a critical point. The debate itself reveals the difficulty. But beyond the total number, you mentioned reserves earlier. Are they distributed evenly across the financial system? Could some parts of the banking sector feel more strained than others, even if the aggregate numbers look okay?
This is a crucial nuance, and it's often overlooked. The distribution is definitely uneven across the nation's, 4,000 or so banks. It's not like every bank has an equal slice of the liquidity pie.
Right.
What tends to happen is that the larger, more diversified banks might have ample reserves, they're deeply involved in capital markets. But smaller regional banks, which might be more reliant on traditional deposits and less plugged into those complex funding markets, could find themselves with tighter liquidity.
So some banks might be sitting comfortably, while others are really feeling the squeeze. Which types of institutions are most vulnerable here, and what would that look like if they start to struggle? Could it ripple out?
Exactly. Smaller regional banks, or perhaps those with less diverse funding sources, might find it harder or more expensive to access overnight funding if overall liquidity tightens. This could show up as them having to pay slightly higher rates to borrow cash, maybe dipping into their own liquidity buffers more quickly. Now, it might not immediately trigger a systemic crisis like 2008, but it could create localized stress points. And if enough smaller institutions feel that pinch, it can certainly contribute to overall market jitters and volatility. It's less about direct contagion, maybe, and more about increasing the general friction in the financial system.
Okay, so what does all this mean for, the individual investor or just someone trying to stay informed? What should we really be keeping an eye on as September progresses?
Well, vigilance is absolutely key here. September 15th, as we said, stands out as the primary flashpoint, the day the system faces its biggest immediate test with those tax payments hitting. If problems do arise, they will likely show up in two key indicators you can watch. First, a noticeable drop in those overall bank reserve levels, especially if they dip towards or below those critical thresholds we discussed, like $3 trillion or $2.9 trillion. And second, a corresponding rise in short-term borrowing rates, particularly in the repo market or reflected in that SOFR rate. Keep an eye on those numbers. They're like the system's vital signs.
Reserves down, rates up. Got it.
And for market participants, the advice is pretty clear. Tread carefully around that mid-September period. While a full-blown systemic collapse looks unlikely given the Fed's enhanced tools and the market having learned some lessons from 2019, volatility in dollar liquidity is very possible. Think of it maybe as increased choppiness on the financial seas rather than a full-blown tsunami warning.
That brings us to the end of today's deep dive into U.S. dollar liquidity and the potential stresses looming in mid-September. We truly hope this exploration has been useful and given you a clearer picture of these complex yet incredibly vital financial mechanisms.
And before we sign off, just one more reminder to check out Hui Wang's A History of China series on Amazon. Covering dynasties all the way up through the Jin, it's an incredibly engaging and comprehensive resource for anyone looking to truly understand one of the world's most enduring and influential civilizations.
Available in both ebook and paperback, it really is a must-read for anyone seeking a deeper global perspective.
Thanks so much for joining us for this deep dive today. You know, the coming weeks will certainly test the resilience of this financial plumbing. The big question really remains, will the Fed's enhanced tools and the market's learned resilience prove sufficient this time? Or are we perhaps underestimating some of the invisible pressures lurking beneath the surface? Something to keep in mind as we watch September unfold. We'll be back next time with more insights on the global economy and financial markets.
Until then, stay informed and stay curious. Goodbye.